We're going to go over two stocks that consistently beat the S&P 500 in capital appreciation and at the same time pay dividends. These are stocks you probably have heard of, but never thought about investing because they don't get a lot of the media hype like other stocks do. I can assure you that these have been consistently rewarding their shareholders for decades and don't see any reason why this would stop. These are dividend stocks that you could hold forever. Let's quickly go over again what most people think of when they think of dividend investing and why I personally like dividend growth investing much more. So, with dividend investing, you're focused more on higher dividend yields with little growth. You don't really care about the capital appreciation as much, but chances are these companies have already reached their peak customer base and are simply continuing to provide the goods and services over and over again, such as a utilities company. An electric company probably isn't making some revolutionary breakthrough in acquiring more customers or improving their product. So, in order to make their stock more enticing to the investor, they pay out most of their earnings to investors as a form of a dividend. Now, I would hope if they're paying a big dividend that they are a profitable company, and if they are not, that's a huge red flag. So they are also often undervalued or priced appropriately. That's because investors aren't factoring in future growth into that stock price. Future growth is extremely hard to measure and predict, which is why a lot of companies that IPO are so volatile to price fluctuations. They also have a low PE ratio and low price to book ratio. Dividend growth investing, on the other hand, these companies usually start out with a lower dividend yield and a higher growth potential, meaning the stock price might capitally appreciate more. And these companies may already well be established, but they haven't necessarily reached their peak. They're still innovative, they have new products coming out, and they are also doing mergers and acquisitions to continue to increase their earnings. These stocks may be overvalued because investors are trying their best to measure future growth into that stock price, which in turn leads to higher PE ratios and higher price to book ratios. So, as you can see here, a utility company may pay out about a 10% dividend, which is a very good rate of return. I'm not going to lie, that's a great return, but as you can see here, they're not increasing their dividend over time. So, you're going to continue to get that 10% yield every year, but the stock price probably won't change much. It might, in fact, it might even go down. But when you're investing in dividend growth companies, you might start off with a lower yield, but eventually, as time passes, and what's important here is the company has to be consistently be increasing their dividend. So eventually, as they continue to increase their dividend, around the 15-year mark, you'll actually break even with the company that's just paying out a high dividend. And then eventually, you will be having a higher yield on cost every year as you continue on. So that's why time is really your friend in this particular scenario. The first cash cow we're going to talk about is Pepsi. Now, you have all heard of their soft drink before, but they also have so many other products than just that. This is taken directly from their 10K report, and this is all the brands that they have that had over $1 billion in sales in 2018. 22 different brands. And I made a video on how big Disney was, but I could also make a video on how big Pepsi is and how many different brands that they have. They might not explicitly have their PepsiCo name on it. So you also see Starbucks here. Now they obviously don't own Starbucks, but they have a partnership with them that allows them to sell some of their products at Starbucks. So that's how they have over $1 billion of sales there. So many other products that you probably see all over stores: Mountain Dew, Gatorade, Diet Pepsi, their Naked brand. They're also trying to include some more healthier foods, so I know Naked is part of that. Aquafina water, Fritos chips, Sierra Mist, you name it, PepsiCo has it. This is how Pepsi did last year in 2018. A mix of its revenues came almost in half directly, that was food, and almost 50% was beverage. So nice 50-50 split there between food and beverages in terms of how they're making their money. And I also really like this is that it has its sales, 57% of them come in the United States, the largest economy in the world. and then another 43% come from outside the US. So I think that's a very nice split here. It's not dependent too much on one particular country. And in terms of its revenues, it's broken down here in terms of where it comes from throughout the world and by its division. And Pepsi has continuously had great net income numbers. It made almost $13 billion in net income last year and has been consistently putting around the 6 billion number. So as you can see, it can really increase just year over year, and that's something you really like to see in a company like this because you want to make sure that they will continue to be profitable so they can pay out those dividends. Now here, if you invested $100 in the S&P 500 and Pepsi in the end of 2013, at the end of 2018, you would actually come out just barely on top, but keep in mind that this has been a huge bull market, so that usually favors growth companies a lot more than recession-proof companies like Pepsi. But a lot of us are predicting that we're going to have an economic recession here very soon, so I guarantee that Pepsi will do a lot better than most of the companies on the S&P 500 just based on their track record. So once you hit a recession, something like Pepsi is a good stock to own. Alright guys, so here's where the real magic of dividend growth investing comes to fruition here. So, might look like a lot of information on the screen, but we'll go through it here. On May 24th of 2009, 10 years ago, Pepsi was trading at $52.05. On May 24th of 2019, just this Friday, it was trading at $129.50. In that full year of 2009, if you had held on to Pepsi, you would have received a total of $1.80, assuming you owned one share. You get a yield of 3.45%, which is calculated by taking the dividends per that year, 180, divided by the share price, 52.05. So in 2019, you're now getting paid $3.82 per share because they have consistently been increasing that dividend, and that gives you a yield about 2.95%. So now you would think that's low, that you are actually doing worse in 2019. But here's the key difference here is that you actually, when doing your yield on cost calculation, would take the original share price that you bought it in 2009, which was $52.05, and then the dividends paid in 2019 are now $3.82, this is more than double what it was 10 years ago. So that yield on cost is now an amazing 7%, which is the standard return on the S&P 500 is 7% throughout history. So you're already getting that almost guaranteed in dividends. Of course, there's always a small chance companies can cut them, but with a stock like Pepsi, it's probably pretty reliable. So again, we are taking the dividend paid in 2019 divided by what we originally bought it for 10 years ago, and that gives us an amazing yield of 7%. And not only that, we also got 148% capital appreciation. With stocks that are paying ridiculous dividends, you're not going to get this type of capital appreciation. It's also $25.58 in dividends in your pocket that no one can ever take away from you because Pepsi has already paid them to you. So Pepsi pays out about 67% of its earnings to shareholders, and it has been paying dividends for an amazing 46 years. If you think about all the different market conditions that have happened in the last 46 years, that shows that Pepsi has been able to survive that storm. All the different recessions, failures, wars, whatever was going on in the news, Pepsi throughout all that time has continued to reward its shareholders. Now this would be a good time to remind you guys to subscribe to the channel, like the video if you haven't already, and be sure to comment before we move on to the second stock we're going to talk about. The second cash cow we're going to talk about is 3M. 3M is one of the largest conglomerate companies in the world, they just make a whole lot of things in a whole lot of different categories. The amount of disrespect this stock has seen in recent weeks is getting a little overboard in my opinion. You can't expect a company to consistently be beating expectations every single quarter. Companies will occasionally have hiccups like they did in their Q1. Their Chinese trade wars have really hit 3M, but I do think all of this will be short-term friction. 3M makes over 55,000 different products, and those will still be sold regardless of what 3M's stock price may be. So this is from their 2018 10K. They had a 3.2% organic local currency growth year over year. Their adjusted earnings increased. They returned 22.2% on invested capital. So things that they're spending money and R&D on, those are really paying off. 91% free cash flow. Sales, gap earnings up 12.1%. And they have also returned $8.1 billion to shareholders via dividends or share repurchases. Now, do these look like activities that a stock that is crumbling and is going to fail? Do these look like the actions of a stock like that? No, these look like the actions of a well balanced, healthy stock that will continue to provide for its shareholders. Here's all the organic growth and sales growth of 3M's different segments. So it makes so many industrial products, safety products, healthcare, electronics and energy, consumer. 3M makes products for all these different types of segments, and as you can see, they've all grown in the past year. Sales across the world have also increased. And what's funny was when I was doing research for this company, on their website, look how big this menu bar is for all the different products that they have. They even have subcategories for products. That's how many different things that 3M makes. It is a huge conglomerate company. It does not deserve the amount of disrespect that it has been getting. We're going to do the same calculation we did with Pepsi with 3M. So on May 24th, 2009, 10 years ago, 3M was trading for $57.10. In 2019, that increased to $166.09 a share. Total dividends paid out 10 years ago was $2.04. Now, if you had held on to the stock, it's more than double that. So you get 5.76. In both cases, the yield was about 3.5%. But of course, the key difference here is the yield on cost. So when we bought it 10 years ago, it was 57.10, and we would take the dividends. We still get paid here in 2019 at $5.76, and you get a huge yield on cost of 10%. That is amazing yield, beats the average return of the S&P 500, and what's even better is that you get 190% capital appreciation that happened in the last 10 years just for holding on to this stock. $35 in dividends collected that you will always be able to keep, can't be taken back, pays out about 56% of its earnings to shareholders, so plenty of room to continue growing, continuing to put that R&D cost for more innovative products that I'm sure 3M will continue to do in the future. What's even more amazing is it has 60 years, one of the few companies that is a dividend king, 50 plus years of increasing its dividends and paying them consistently. Regardless of all the turmoil that happens every day with the media, the news, 3M has been paying its shareholders very well. That's really going to do it for the video, guys. Be sure to let me know if you guys like this type of video. I always love the feedback, both positive or negative. As always, be sure to subscribe to the channel. Definitely plan on making more videos and going over my stock portfolio, added a couple new positions, and will continue to be investing for the long term. Enjoy these little memes I have of Finding Dory and Patrick from SpongeBob.